Welcome to class. This is the continuation of the letter on national income accounting. As we saw the last time, the GDP is a measure of the level of economic activity that has taken place in a country over a period, usually 1 year. And this GDP has its related concepts which we'll look at. So we'll start off by looking at the difference between gross domestic product and gross national product. As I've explained earlier, GDP measures what is produced within a country, whether the production is undertaken by the nationals or foreigners. It doesn't matter. Once the production takes place within the borders of a country over a period of 1 year, that measures our GDP. Now, the gross national product is interested in measuring the economic output of nationals of a country, irrespective of where they live in the world. So, for instance, we may want to know the total output of Ghanaians in the year 2023, irrespective of where they live in the world, whether they are living in Ghana or they are living in America, Japan, or Kuwait, Iraq, Russia, Ukraine, Britain, Germany, or wherever. So the gross domestic product is focused on what is produced within the borders of a country, whether it is produced by nationals or foreigners, it doesn't matter. But gross national product is concerned with the output of nationals of a country for a period of 1 year. And we can always convert from GDP to GNP. So if we take to convert GDP to a GNP, we take the GDP, which is the output of both nationals and foreigners, and take away the economic contribution of foreigners living in the recording country. Say for instance Ghana, we take the GDP of Ghana for a particular year and subtract the income earned by foreigners in Ghana in that particular year, which measures their contribution to Ghana's GDP. Then we add the income earned by Ghanaians living outside Ghana. So Ghanaians who are living abroad, we add their income to the GDP minus the income earned by foreigners. When we do that, then we arrive at the GNP. So we can always convert GNP to GDP and GDP to GNP. In many textbooks, the difference between income earned by foreigners in Ghana and the income earned by Ghanaians living abroad is usually referred to as net factor income. So GNP is equal to GDP plus net factor income. The net factor income can be positive or negative depending on the difference between income earned by foreigners in Ghana and the income earned by Ghanaians living abroad. So in a nutshell, the GNP is simply trying to estimate how much citizens of a country have earned in a particular year, irrespective of where they live in the world. Then we can also talk about GDP at factor cost and GDP at market price. Normally, the market price of goods are higher than the cost at which those goods are produced as a result of taxes, indirect taxes imposed on goods by the government. In some cases, the government also subsidizes products. So when we measure GDP using the cost at which the output is produced, then we are talking about GDP at factor cost. So we can always convert GDP at factor cost to GDP at market price. So the GDP at market price is just the GDP measured using market prices. GDP measured using factor cost or cost of production or how much is paid to owners of factors of production is the GDP at factor cost. So GDP at factor cost is equal to GDP at market prices minus indirect taxes plus subsidies. Alternatively, we can say that GDP at market prices is equal to GDP at factor cost plus indirect taxes minus subsidies. So we can always convert GDP at factor cost to GDP at market prices. Nominal GDP and real GDP. Nominal GDP is also known as GDP at current prices. Refers to GDP measured using current period prices. So for instance, if you want to calculate the GDP of Ghana this year using this year's prices in the market, then we refer to that as nominal GDP. The same way, if you calculate GDP of the year 2020 using the year 2020 prices, then we refer to that GDP as nominal GDP. If you calculate GDP in the year 2021 using the year 2021 prices, we refer to that as nominal GDP. One of the problems with nominal GDP is that they don't allow for comparison of GDP of one year to another, because the GDP is made up of prices and quantities of output produced. This in the nominal GDP can change. For instance, when you are calculating the nominal GDP of a particular year, the prices of goods from one year to another will change, and the outputs also from one year to the other year will change. Therefore, you cannot compare the output of GDP in one year to the output of GDP in another year when GDP is measured in nominal terms, because you cannot tell whether the higher GDP is as a result of higher prices or lower prices, or higher output or lower output. So in order to make GDP over a period comparable, we use a real GDP, or we compute the real GDP. The real GDP is also known as GDP at constant prices. So what we do when we are computing the real GDP is that we take a particular year's prices and use that year's prices to measure output or to value output over the subsequent periods. For instance, we can take 2010 prices as the reference price and use 2010 prices to measure GDP in 2010. We use the same 2010 prices to measure or to value output produced in 2011. We use the same 2010 prices to value output produced in 2012, in 2013, in 2014, all the way to 2023. When we do that, when we value output of various years using a reference period price like 2010 prices, then the GDP of 2021, 2020, 2020, 2019, 2018, all the way to 2011 are referred to as real GDP, because the price at which these GDPs are measured remain the same. So if there should be any change in the GDP of one period to another, then that change should be coming from the actual output produced. So when we talk about real GDP, we mean GDP calculated over a period using a reference period in the past to value output produced in subsequent period. We can easily convert a nominal GDP to real GDP by using a GDP deflator. GDP deflator is just a measure of how prices have changed between two periods. So let's say in the real world, GDP is calculated nominally. That is, you use this year's prices to measure this year's output. You will use in 2022 prices were used to value 2022 output. The same with 2020. We use 2020 prices to value 2020 output. So that is how those are the nominal GDPs. But you can also calculate how much prices have changed between 2020 and 2021, or between 2020 and 2022. So when you are able to calculate that price change, you can use it to adjust the nominal GDP so that you can get the real GDP. All that you are trying to do is to remove the effect of price change in the nominal GDP, so that it is as if you are using a constant price of a reference period in calculating the GDP of that particular year. The nominal GDP the real GDP allow us to compare the GDP of one year to another. So if there is an increase, then we'll be talking about economic growth. If there is a decrease in real GDP, then we'll be talking about economic decline or decay. Another concept you can also look at is gross domestic products and net domestic products. The GDP is said to be gross because we fail to account for depreciation. Let's say you take a brand new tractor produced last year to produce maize this year. At the end of the year, the value of the brand new tractor will not be the same at the end of the year. What it means is that the maize that has been produced takes part of the tractor, takes part of the value of the tractor is incorporated into the maize produced. Therefore, the value of the maize also contains the loss in value of the tractor. So when we value this maize without subtracting the loss in the value of the tractor, then we are talking about gross output. So when you calculate GDP without removing the portion of capital that is lost as a result of production, then we are talking about gross domestic product. So when you take away the loss in capital, then we are referring to net domestic product. You can extend the same concept to net national product, which should be equal to gross national product minus depreciation. So the depreciation is just money set aside to restore capital to its initial level as a result of its use in production. When you use capital to produce, part of the capital is used up. So the money that you have to set aside so that you can restore this capital back to its original state is the depreciation. The next concept we'll look at is GDP per capita or per capita GDP. They mean the same. GDP per capita GDP. Which you define as GDP divided by the population of a country. Sometimes we can be misled into thinking that a country with a high GDP implies that citizens of that country enjoy better quality of life than others. But this may not be the case, because a GDP of a country takes some number of human beings to produce it. So to make a comparison, or to use GDP and national income statistics as a tool for comparing quality of life of citizens, it is not enough to just look at the big GDP. It is better we look at how each person in that country will get out of that GDP, so that we can compare it to that of another country. So we use a hypothetical case to illustrate that situation here. We have two countries, Ghana and Nigeria. Ghana's GDP is $28.8 billion, and that of Nigeria is 108 billion. Just by looking at this, you may think that Nigeria is far richer, and for that matter, the citizens of Nigeria have better quality of life than Ghanaians. But look at the population that is producing these GDPs. In Ghana, only 24 million are producing the 28.4, but in Nigeria, 120 million people are producing the 108 billion. So if you divide the GDP by the population, this should show how much each person in that society will get out of that GDP. In the case of Ghana, a Ghanaian will be getting $1,200, whilst a Nigeria will be getting $900. If you compare the two, you can see that on the average, a Ghanaian will be earning more than a Nigerian. So the more your income, the more goods you can consume, and the better your quality of life. So if you want to compare the quality of life, or what we call economic well-being, or the welfare of citizens of countries, you use per capita GDP and not the GDP. We'll now look at the uses of national income statistics. One of the uses of national income statistics is to monitor the behavior of the economy. And this is what politicians do a lot. When you see politicians talking about economic issues, all that they are doing is to be monitoring the behavior of the economy. That is, in one period, what are the economic statistics? In another period, what are they? So they make comparison. The national income statistics is a very comprehensive data set that gives an indication about the sectoral contribution to the GDP. Every country's economy can be disaggregated into agriculture, industry, and services sectors. So the GDP statistics will tell you the contribution of the agriculture sector, the contribution of services sector, and the contribution of the industrial sector, and how these sectors contributing to GDP are changing over time. If the agriculture sector is shrinking by way of its contribution to the GDP, and manufacturing and industry and services sector are rising, then that is an indication that the country is moving towards a developed income status. But if it is the reverse, if the agriculture sector is becoming larger and larger, then you must know that that society is moving towards a low income country, because income in agriculture sector is generally lower compared to income and in the industrial and services sectors. So the movements in these economic aggregates are used to judge the success or failure of economic policies pursued by a government. So if you want to compare NDC to NPP government, you cannot, in terms of economic achievement, you can only do that by comparing the economic statistics of the two regimes. And this data is also used to monitor production, household consumption, government, how much government is spending, how much a nation is saving or pumping into capital formation. That is, when we produce output, do we save a lot to increase output in the future, or we consume a lot of them and only save something small, or devote something small to more capital? How much are we producing and selling abroad? How much are we also buying from outside into the country? And national income statistics allow us to measure all this and monitor how they are changing over time. And how these things behave to a sense over time can allow us to determine whether a country's economy is moving in the right direction or is moving in the wrong direction. Macroeconomic analysis. This is a a situation where national income statistics are used to see whether there are causal relationships between and among economic variables. So this kind of analysis are very useful for policy making. For instance, if price of goods increase, does it create more unemployment or it increases employment? Does it allow the country to export more or export less? This kind of analysis can be done using data that you generate from national income accounts. So private sector investors, for instance, we have been hearing of a credit rating of Ghana, which is done by Standard and Poor and others. So the current economic situation in Ghana has found itself is as a result of these international organizations using the economic statistics of Ghana to determine whether Ghana is credit worthy, whether Ghana, when you give money to Ghana, it can pay back. And based on the analysis they do, people decide whether they should keep their money in Ghana or take their money away. And those decisions resulted in the economic situation we have found ourselves in Ghana now. So national income statistics are very useful in macroeconomic analysis, which help investors to decide where to send their investment. National income statistics is also very important when it comes to international comparison. For instance, you want to know whether the quality of life of a Nigerian is better than that of a Ghanaian, or that of a Togolese, or that of an Ivorian. How do we do that? We can only do that based on national income statistics. And generally, we use per capita income to do that. Uh, we also use uh, GDP and national income statistics to determine a country's eligibility for international loans, aids, and other funds, and the condition under which such aids or funds are made available to a country. For instance, Ghana, see, there are a lot of international organizations like NANIDA, USAID, UK Aid, Canada Aid, Australia Aid, and all these organizations, they provide humanitarian assistance to various countries. How to determine whether you can get assistance from this country depends on your national income statistics. Some countries that have very low per capita income get a lot of support. Aid, that is free money that you get, meaning they will give you the money and they not expect you to pay back. Countries too may want to develop, but they may not have the resources themselves, so they have to go and take loans. Your ability to borrow and the conditions under which the money will be given to you depends on the your national income statistics. Another use of national income statistics is in determining quota contribution of countries to international organizations. If you take an international organizations, they are funded by contribution of members of that organization. So the UN, ECOWAS, AU, World Bank, IMF, World Trade Organization, African Union, and the rest. All these international organizations are funded by a contribution of their members. But the question is, how do you determine how much each country should contribute? You cannot say that each country should contribute equally because all countries are not having the same level of income. Your citizens across these countries don't have the same level of income. So you can use the national income statistics to determine how much a country should contribute to such an organization. Then another use of national income statistics uh, is for scholarships. See, there are national income statistics are used to classify countries into poor countries, middle income countries, and high income countries. So, if based on the country you are coming from, your national income statistics will determine whether you are from a rich country, poor country, or middle income country. And for you to qualify to apply for these international scholarships, will depend on which of these countries you are coming from. There are some scholarships that are meant purely for people from very low income countries. So if you are not from a low income country, you cannot apply. The assumption is that you may not be able, because of the country you are coming from, you will not be able to have money to have that kind of quality education. So the scholarship is to help you finance that education. And national income statistics play an important role in this eligibility criteria for international scholarships. I think this should bring us to the end of this topic, national income statistics or national income accounting, where we look at how to calculate the GDP and its associated concepts. Thank you very much and see you next time. Bye.